GIIB Holdings Berhad was established in 1990 and headquartered in Nilai Negeri Sembilan. Moreover, their corporations divided by several segments, which are rubber compound, property development, retrading services, trading and other services. The company is well known for its own local brands such as Raptech, Tough Trade, and Supercool. These mentioned brands are operated in different ways, especially when it comes to repair and reuse old tires. Same goes with other special industrial purposes. Based on the profitability ratio, the company recorded return on assets (ROA) of negative 24.86% in 2022, negative 23.64% in 2023, and negative 18.19% in 2024. This indicates that the company has significant net loss relative to its total assets, which means the company is losing 24 cents in every 1 ringgit of asset in 2022 and followed by recent years. The company's assets are not efficiently used to generate its revenue and shows poor cost control. This led to excessive expenses. Next is return on equity (ROE) of negative 37% in 2022, followed by negative 48.19% in 2023 and 2024, which is negative 61.94%. It is clearly means that the company's financial performance is worsening. These figures suggest that the investors' capital is poorly managed, which unable to generate profits. The net profit margin shows from 2022 to 2023 shows slightly increase in the percentage, which due to the decrease in total revenue and move to 2024, it shows that the company has increased in total revenue, which shows improvement in revenue generation. However, for gross profit margin indicates significant increase in gross profit from negative 1.55% in 2022 to 38% in 2023, which means the company earned 38 cents of net profit for every 1 ringgit of revenue, but decreased in 2024 by 18.65% due to the decrease in net profit during the year. In terms of liquidity, the company is sufficient liquid to meet its short-term obligation. This is because in 2022, the current ratio is 1.05, which is good. But however, in 2023 and 2024, this is decrease in the ratio figure, which will lead to have difficulty to cover liabilities. Moreover, the company's position through solvency ratio in 2022 still shows lower risk on 0.49, which means the reliance on debt to finance assets relative to shareholders' equity is still low, followed by 0.93 in 2023 and 1.21 in 2024, following by interest turnover ratio has significant decrease from 7.77 in 2022 to 22.64 at 2023 and recovered in 2024 at negative 13.11, but still remain negative to cover its interest expenses by revenue. Efficiency ratio. Asset turnover ratio is getting lower from 6.48 in 2022 to 2.49 in 2023, but increased again at 6.04 in 2024. This is made due from slow in-stock movement. Next is strength. One of the strengths of the company is sustained inventory management. The company managed to maintain effectiveness of its inventory management, in which they recovered all the sudden drop of inventory turnover ratio in 2023 within a year by a significant improvement in 2024 and helps company to continue with operations. Next is revenue growth. The gross profit of the company has drastically increased from negative 1.55% in 2022 to 20.21% in 2023, which reflects to the ability of the company to generate income in core business level and implies better cost control. Next is the risk of the company. The first one is deteriorating liquidity position. The company shows poor liquidity of current assets in order to meet its short-term obligations and show cash flows constraints. Next is rising financial leverage and poor interest coverage. Based on the debt to equity ratio, the interest coverage ratio The company has shown high reliance on debt to finance relative to shareholders' equity and inability to cover the interest expenses. Finally, the company's overall financial performance reflects a large downwards in its financial performance despite there is slightly improvement in certain key areas of operations. Profitability indicates consistent net losses over the past 3 years from 2022 to 2024, which directly contributes bad impact to the liquidity and efficiency of the company, since net profit is the main pillars of business sustainability. Poor liquidity indirectly may force company to seek for expensive short-term financing and increase its interest expenses since the options is limited due to the poor financial performance. Therefore, the recommendation for investor is to sell the company's stock or avoid buying it at this time. This is due from the results of financial ratio that shows the company is not generating sufficient returns, faces liquidity and solvency challenges that affect the shareholders' value as overall. Thus, investors should wait for clear signs of sustained profitability improvement. The liquidity becomes stronger and able to manage the debt levels before considering holding or buying shares in the future.